Good morning, this is Jason Wheeler with Pathfinder Wealth Consulting. We wanted to share a bit of a market update. One bright note is that we are not discussing the COVID pandemic today. Unfortunately, we will be talking about the Russian invasion of the Ukraine. Omicron has come quickly, and luckily the U.S. has done very well with that variant. Very much hoping that we could experience what they did in South Africa, and actually we did even better due to our higher vaccination rates. So we still are moving forward both economically and with the markets in regards to the recovery from the pandemic. But now we have a new issue that has surfaced that I'd like to discuss in more detail. Just a few days ago, Russia had occupied a few areas of the Ukraine, and they had really already partially controlled with the Russian separatists, and it was not really under Ukrainian government control. But yesterday there was a full invasion with cyber attacks, tanks, and aircraft. It was the largest deployment since World War II. But no matter what you hear on the media, this is not unprecedented. In fact, in 2008, Russia attacked Georgia, and in 2014, they attacked Crimea. What's different this time is that Putin got away with both of those relatively easy. And now that people are looking forward, they're wondering how this one will be dealt with differently. And so I wanted to first kind of shape the way to think about this is in terms of just in general, how do we think about bad things in the marketplace? So I would give you two paradigms to consider. One is what I will call the natural disaster paradigm, which means something like a hurricane or a tsunami, an earthquake. So something that comes in quickly, typically unexpected to most degrees, and typically very devastating. The way that the markets react to those is that they have a quick hit, usually a quick drop, and then they also recover quickly because these are, generally speaking, short term in the actual event itself. And then we start recovering. It's very, very much in our area, hurricane example, right? So a hurricane comes in, we get hit by a hurricane, we are down for a few days, hurricane moves through, we start to rebuild. And that's how the markets react to particular events. The other way I would get you to think about things is more like this pandemic that we've been in this paradigm. So with a pandemic, there is really, there's no clear extent to the damage. It doesn't necessarily have a timeline, and so it's a lot more ambiguous. And so it gets harder to really wrap your mind around because the scale may seem larger. There's a lot of different moving parts. The good news about what's going on right now with the market in Russia in particular is that even though the media is trying to treat it like a pandemic, historically the markets treat military action more like a natural disaster. Not to mention we also have already been in this pandemic, so we're a little bit more used to dealing with the particular areas. So let me get a little more specific. In 2008 and 2014, when Russia invaded other areas before, the market dropped about 5 to 6%. And then it literally recovered within weeks. We saw yesterday a drastic drop in the market, and actually the market finished up yesterday, and today it's finishing positive as well too. Kind of counterintuitive to some of the fears that many of you probably had. I talked to a couple people. We really don't get a lot of phone calls on market action because our clients know that we make sure that their portfolios are well diversified, and we know that if they need cash flow out of their portfolios, we've already set that aside. So generally speaking, we don't get lots of phone calls, but this is certainly something that the news media and something that we should be concerned about, and we are going to continue to watch it. I don't believe this will be like a 9/11 on the military side. I don't think this is going to turn into a full-scale global war. But I will also tell you that it's something we are going to keep our eye on and keep watching it. From a stock market standpoint, when this happened, we were already down over 10% in the S&P 500. And quite honestly, we were 20% down in the NASDAQ, which is an actual stock market crash for the NASDAQ stocks, the big tech stocks. We're also already in this pandemic economic recovery period. So we know what it's like to have supply chain issues, and we know what it's like to have, offset in demand and working shortages and things like that. So, we're almost a little bit more prepared for this than I think we would have been had this come with the market highs, and also with, no pandemic. This may have been a little more shocking, but I think we're actually able to cushion this a little bit more. And with the market already down when this happened, it creates a little bit more of a floor for us. So think about the stock market as being already close to fair value or on sale. And then this happens. So if stocks drop more, they become much more attractive. And so just mention that there's, these are the kind of opportunities that we look for, not necessarily a time to sell. And so, there are some real issues to consider. I wanted to make sure I addressed a few of those. The U.S. has very little exposure to Russia and the Ukraine. So, being really self-reliant, it's one of those areas that I think the U.S. is pretty good safe haven for investing when it comes to this, and we shouldn't have lots of impact from this. But there are certainly more impacts in Europe and in Asia, and so 40% of the energy that Europe consumes comes from Russia. Russia also controls a major natural gas supply. And so that then leads into things that are created with natural gas, which leads into the food supply issue, which also Europe gets a lot of their food supply issues from Russia as well. There's also industrial metals. So, when you think about it, another supply chain issue coming along, it's maybe different than the one we've been dealing with the pandemic, but it's certainly not something that we haven't been dealing with already. And so we can kind of navigate mentally supply chain issues. We are looking and seeing what folks are doing. I think the market rallied yesterday because there were not harder sanctions, particularly on energies, natural gas or oil, and they were not cut off from the SWIFT payment system, which is basically cutting off the cash flow to Russia. Yes, China does, buy a lot of energy from Russia as well, but the reality is that they don't have the infrastructure there. So, it's not going to be able to replace the amount of money that's going to Europe. And Europe obviously acknowledged that. And so, there's a good chance that Putin could continue to go into Ukraine, could take all of Ukraine without any military intervention from the rest of the world. Not saying that that's the right or wrong thing to do. I'm just giving a analysis of how this could play out, since the sanctions weren't tougher than we thought they actually may have been. So that gave the market confidence that this won't turn into something much larger, and this will be more short-term in nature. It would be treated more like a natural disaster than a pandemic. With that said, supply chain issues. Kind of look in the way that we think about those is back to the inflation discussion. And this does increase inflation risk. Without that going on right now, I'd feel a lot more confident that this was a great buying opportunity. I do still think there's buying opportunity out there, but we are still very cautious of how this may impact inflation. Now, what the Fed will do, we've heard from the Fed already that they probably will still increase interest rates in March. Probably not 50 bips, maybe only 25 bips to kind of see where we're going. But interest rates and inflation are certainly two things that we're still watching very closely. And those are still things that were already impacting the market. So we're not panicked, but we're not taking this lightly. We are watching it closely to see how things are going to pan out. We're also, getting questions in regards to what's the fallout of things like China. Will this encourage China to attack Taiwan? There's no doubt that China's watching it. Especially if Putin succeeds in gaining some more resources and gaining this land, this is going to certainly encourage China to look at opportunities to play chess against us as well. However, China has only rhetorically supported Putin. They really haven't done anything physically. And historically their non-intervention policy is pretty standard for them. So I don't see them doing too much in regards to this case. I also don't know that that's going to play into them attacking Taiwan. It's a very different situation. As I've heard it mentioned, Taiwan is like an unsinkable aircraft carrier. We definitely have more ability to have a military presence there. We've got the Pacific Navy. We've got troops in that area. So from our standpoint, we already have agreements with Taiwan. So the U.S. is in place to defend Taiwan if we so choose. Not to mention that on the supply side, Taiwan semiconductor business would shut down the entire world. So China is probably not in the doesn't have the inclination to shut down the entire world supply chain, because it's going to hurt China, Russia, it's going to hurt everybody, not just the United States. So it is something to be mindful of, but I'm not as concerned about China going there, not to mention they can't roll tanks across the ocean. So it would be a much different physical altercation if it was to come to military might. There are some other areas like Iran, for example. This probably gives Iran some opportunity to negotiate their nuclear stuff, which they were already doing. And being able to provide more oil to Europe, it kind of opens up the door for some of that as well too. So those are things we're watching. These aren't fun things. Historically, these are what we would consider United States enemies. And so, it's not fun to see this happening, but at the same point, it doesn't necessarily mean market and economic disaster. It's a shift of power and shift of where money's going, but it doesn't necessarily mean that, this is going to turn into some kind of global economic recession. In fact, we're actually still economically recovering. We are worried about inflation that could slow things down. What I would say is this probably slows down the recovery a little bit more, but it doesn't derail it. I still think we're moving in the right direction, and it's something we're going to continue to watch. Stocks have already sold off, and looking forward, the valuations are actually starting to become very attractive again. So if we thought stocks were pricey 3 months ago, we'd have to argue now that they're certainly not overpriced like they were then. So that gives us a little more confidence. People have asked about international investments. Should we do anything because we're talking about the impacts in Europe and Asia? Should we not have any international? And I would tell you that we are still looking for opportunity international. If there were to be a further sell-off internationally, we actually would be sort of these gradual contrarians that we like to be. We'd like to add exposure to international if it were to go down significantly more. So, it isn't something that we're going to caution you necessarily against, but it is certainly something that we're watching. As I think about everything that's going on with this situation, it leads me back to just reminding everybody that we build plans based on your timeline and your cash flow needs. We certainly expect to go through bad times economically and in the market. This isn't something that we shy away from. In fact, we build portfolios that can weather these types of storms. Speaking of storms, Rob and John and I all three like to use the hurricane analogy. I think Rob's comment this week was, we get tropical storms frequently, and although they could turn into something more, they really don't do too much damage. And we think of that as like, maybe a 5% pullback in the marketplace. It happens a couple times a year. It's normal. It's not devastating. When you think about a category 1 hurricane, maybe a 2, you think more along the lines of a 10% pullback. And those cause some damage. And in particular, if you don't have a well-built house, if you don't have your structure, if you don't have your well-built portfolio, it could suffer more. And that's what we're in right now. We're in a category 1 or 2. This has been a 10% pullback. But we build portfolios with high quality, and we build them diversified. So we're not worried about that Cat 1 either. Hopefully it gets through quicker, and it's not one of these that sit on us for days and days and days, but instead, we're able to move through. In 07, 08, that is the Cat 4, 5, that can come out of the blue every so often. We always fear those, but even those, they do a lot of damage, and it takes a while to rebuild, but we still rebuild through those, and there is light at the end of the tunnel. And so, I would just encourage everybody to know that we build, well-constructed houses that can handle the storm, and that's the portfolio that we build for you. So if you have any questions, let us know. I'm glad we're not talking about Omicron. I don't think that the Russian invasion will turn into a World War III, but that is something that we will continue to monitor. We do expect there to be volatility around this for, it could be 3 to 6 months, but we do anticipate a continuing economic recovery, which fundamentally shows the strength of the U.S. economy. I would mention that there's still about $1.4 trillion of money that came out of the COVID government dollars that's still sitting out there ready to be put to work as well too. So that's going to further support the economy. And there's a lot of things that are happening. If you have any questions, if you want more information, certainly send us an email, give us a call. But just wanted to give a quick market update. And hope everybody's doing great. I'm glad the COVID is starting to be in the rearview mirror, and hopefully everybody's getting out and enjoying not only the outdoors, but also friends and family, some of it for the first time in a long time. So with that said, we appreciate being able to serve you. Let us know if we can ever do anything for you. Thank you.